Here are the crypto top headlines covered in this video. Bitcoin ETF ads may appear on Google starting Monday, community speculates. Next, tokenization in 2024. Exchanges need to build trust. Also, Bitcoin ETFs are wrapped in thin layer of indirect regulations, says CFTC chair. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We are a new channel here on YouTube, and would greatly appreciate it if you would click on the like and subscribe buttons, as well as the notification bell. It does help support the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline, Bitcoin ETF ads may appear on Google starting Monday, community speculates. The crypto community is pondering the potential impact on spot Bitcoin ETFs given Google's handling of 100,000 searches per second. On Monday, January 29th, Google is set to update its policies to allow certain cryptocurrency products to be advertised on major search engines. Bitcoin exchange-traded funds appear likely to meet the criteria, sparking speculation within the crypto industry. In December 2023, Cointelegraph reported that Google's crypto and related ads policy will be revised on January 29th to allow ads from advertisers offering cryptocurrency coin trust targeting the United States. With the recent approval of 11 spot Bitcoin ETFs by the United States Securities and Exchange Commission on January 10th, investors purchasing shares in a spot Bitcoin ETF acquire a stake in the fund's Bitcoin holdings. This aligns with Google's updated requirements. Financial products that allow investors to trade shares in trusts holding large pools of digital currency. Crypto analysts are optimistic about the potential inflows to Bitcoin ETFs, citing Google's high transaction processing capacity in searches. According to recent data from Demand Sage, Google processes 8.55 billion searches daily. However, Google vaguely refers to the allowed products as cryptocurrency coin trusts. Meanwhile, one of the largest Bitcoin trusts, the Grayscale Bitcoin Trust or GBTC, recently converted to a spot Bitcoin ETF as part of the several approved by the SEC on January 10th. Previously, buying GBTC shares on the primary market was only available to accredited investors and subject to a 6-month holding period. Accredited investors must have a net worth of over $1 million or more than $200,000 in earned income over the previous 2 years. These rules are in place to protect potential investors with limited knowledge from risky investments that may result in them losing their funds. However, spot Bitcoin ETFs are available to the general public in the United States. They are regulated under the Securities Act of 1933, making them a potentially safer option for Google to consider in advertising. In August 2021, well-known cryptocurrency trader Michael Van de Poppe was optimistic about the influence of Google ads on Bitcoin-related products, especially in light of the SEC chair exploring Bitcoin futures ETFs, which were approved in October 2021. Let me pause here for a moment. If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline, Tokenization in 2024. Exchanges need to build trust. In 2023, the market for tokenized business assets grew by between 16% and 23% in CAGR, or compound annual growth rate. Still, even the most optimistic valuations agree that tokenized assets currently account for less than 11% of crypto's total valuation. While some dub tokenization a failed technology, the macro trends for its adoption are finally gaining steam. According to DeFi Llama and Fed's research, the fraction of real-world assets in DeFi more than doubled over the last year. The European Investment Bank now issues tokenized bonds, while KKR has started to tokenize private equity fundraising. As the regulatory environment is preparing for a merger between TradFi and blockchain, it is up to exchanges to build what no developers have been able to thus far: trust. Fractionalization in secondary markets. One of the original reasons for tokenized asset design was asset ownership fractionalization and the creation of secondary markets for highly illiquid assets like real estate, fine art, and bonds with large face values. The provision of additional liquidity and renewed attention from retail investors in search of portfolio diversification are long recognized factors in the stock market, represented by the popularity of stock splits. Overall, financial markets tend to evolve towards higher liquidity and diversification efficiency. From overseeing and rebalancing individual stock pick portfolios, retail investors and asset managers switched to investments in mutual funds and ETFs. In 2022, the total volume of ETF trading in the U.S. constituted 32.5% of the country's equity market transactions. Unsurprisingly, research shows that an increase in ETF ownership results in higher common liquidity measures for the underlying stock. Tokenization is the trend's natural step forward. With smart contracts, ownership of virtually any tokenized asset can be fractionalized and resold via shared pools. Tokenization aligns with another trend in traditional finance, the rise of secondary markets. Sufficiently deep secondary markets prevent investors from worrying about liquidation costs or large bid-ask spreads and provide more accurate valuation metrics and cheaper costs of raising capital. Meanwhile, illiquid assets gravitate towards secondary markets. For example, secondary trading of private equity funds increased fivefold from 2012 to 2022, and however controversial the role of MBS in the global financial crisis may be, housing availability in the U.S. would never reach its current state if Fannie Mae and Freddie Mac didn't stand at the other side of the transaction. Currently, the establishment of many secondary markets is impossible due to geographic balkanization and regulatory roadblocks. An example of this is how foreign ownership of real estate is limited in many jurisdictions. However, a real estate trust with tokenized claims on its balance sheet, traded at a centralized exchange with its KYC and AML procedures satisfying local licensing rules, would circumvent both of these design issues. The private market revolution. Private markets are applying increased pressure to their public counterparts. According to BlackRock, private credit volume rose threefold from 2015 to 2023, but this pales in comparison with the private equity data. The year 2021 was an unusually good one for global IPOs, with 3,260 offerings and a total value of $626.6 billion. Yet, private equity closed 8,548 deals with a total valuation of $2.1 trillion, offering an annualized excess return of 4.1% over public market performance. From 2000 to 2021, private equity's assets under management reached $11.7 trillion in 2022, almost 4 times the GDP of France. So far, LP investment in a private equity fund is limited to UHNWIs, or ultra-high net worth individuals, and institutional investors, as the minimum investment sizes are extremely large. Yet almost $4.5 billion in private credit is already tokenized, yielding an APR of 9.3%, while KKR has dedicated part of its new fund to crypto. Creating a tokenized mutual fund-like pool would allow retail investors to tap into the private equity returns or even create an ETF for PE funds. Centralized exchanges are finally getting repo. The year 2023 saw a boom in centralized exchange crypto lending. With tokenization, the exchanges are getting safe collateral in the form of tokenized treasuries. Just as repurchase agreements helped fuel the immense growth of the financial system from the 1990s, providing $3 trillion in daily liquidity to U.S. banks alone, low haircuts will smooth out the crypto lending process. Imagine pledging Bitcoin to invest in tokenized futures on Argentinian grain. This is the ultimate bridge between digital assets and real-world assets. Investors want liquidity and trust. With all the benefits of tokenization, market capitalization is fairly limited. Limited precedent regarding technology use cases is the cause, as is its shallow secondary market liquidity. It is unclear how to establish cross-jurisdictional contractual claims on underlying assets between thousands of investors and sellers. Yet, centralized exchanges can do both. In order to instill confidence from institutional and retail investors, exchanges need to maintain liquidity and trust in the tokenization system, either acting as broker-dealers with liquidity provision, like in the case of American auction-grade municipal bonds, or establishing a system of central custody like the tri-party repo. With ISDA currently in progress on its recommendations on digital assets contracts, the necessary tools will soon be available. Crypto has earned a reputation for disrupting the traditional financial industry, but it often fails to learn from off-chain market design solutions. Decentralized technology can work miracles, but it fails to instill trust. It is up to centralized exchanges to step up and bridge the gap. Our next top headline, Bitcoin ETFs are wrapped in thin layer of indirect regulations, says CFTC Chair. CFTC Chair Rostin Benham declared that regulating the cash market for digital assets has never been more critical following the approval of spot Bitcoin ETFs. The chair of the Commodity Futures Trading Commission, or CFTC, Rostin Benham, believes there is a risk the recent approval of spot Bitcoin exchange-traded funds will be misinterpreted as firm regulations in place for Bitcoin and other cryptocurrencies in general. In a keynote speech on January 26th, Benham clarified there is a potential for retail and institutional investors to misunderstand the legal ruling for spot Bitcoin ETFs following the United States Securities and Exchange Commission's decision to approve 11 applications on January 10th. While the approval now allows investors to expose themselves to Bitcoin without directly holding the asset itself, supervised by an SEC-regulated stock exchange, he argued there is no regulatory oversight for the cash market of digital assets, such as a crypto exchange. There remains nothing firmly in place to address the opaque and inconsistent practices in the cash markets for digital assets. Furthermore, Benham explains that this has repercussions for the transparency of Bitcoin ETFs, since asset management firms acquire the underlying assets for the ETF from the cash market. He raised concerns regarding trade settlement, conflicts of interest, data reporting, cybersecurity, customer protections, transparency, and general market integrity. The ETPs have taken a speculative and volatile asset, wrapped it in a thin layer of indirect regulation, and packaged it as a shiny new product, Benham stated. The enforcement of crypto regulations has been a prominent topic of discussion within the U.S. government in recent times, prompted by the demand from the crypto industry. In September 2023, Cointelegraph reported that the CFTC Commissioner, Caroline Pham, advocated for a limited pilot program to address crypto regulation. Pham warned that the U.S. may soon need to play catch-up to crypto-friendly jurisdictions. She suggested that the program would be similar to regulatory sandboxes previously introduced at the state level. However, many in the crypto industry anticipate that there could be increased regulatory clarity following the U.S. presidential election in November. A recent survey on January 2nd by the Crypto Council for Innovation indicated that most crypto-focused individuals stated that a candidate's position on digital assets would be somewhat, very, or extremely important to their vote. So this concludes our top headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons, as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.